There is a widespread assumption in global markets that the interest rate shock is over. With central banks cutting rates from their recent peaks, the consensus narrative suggests the financial system has safely navigated the tightening cycle. That conclusion is premature. Monetary tightening doesn't fully bite when rates rise. It bites when cheap debt matures. Because the global economy operates on a multi-year lag, trillions of dollars borrowed during the era of near-zero capital are only now preparing to roll over. According to data from S&P Global Ratings, nearly $6 trillion in U.S. corporate debt alone matures before 2030. Most of it was issued when interest rates were at historic lows. Even with recent rate cuts, these borrowers face a structural shift in financing costs. The repricing process is still underway. To understand the scale of this maturity wall, you have to look back to the decade following the 2008 financial crisis. For nearly 15 years, central banks maintained an unprecedented economic environment. Zero interest rates and massive liquidity injections. Capital was essentially free. This cheap money altered corporate behavior. Companies, real estate developers, and governments accumulated record levels of leverage because borrowing carried almost no immediate cost. When the pandemic hit, a final wave of emergency stimulus pushed borrowing costs to historic lows. Smart corporate treasurers did exactly what they were supposed to do. They locked in those rates on 5, 7, and 10-year terms. They delayed the impact of inflation, but they did not eliminate it. They simply bought time. When the Federal Reserve executed its fastest rate-hiking cycle in modern history, moving its benchmark rate above 5%, corporate balance sheets didn't break overnight. A company paying 2.5% on a bond issued in 2021 simply continued paying 2.5%. This insulation created a powerful illusion of systemic safety. Now, the Federal Reserve has begun lowering its benchmark rate. But a rate cut is not a return to cheap money. If a company locked in debt at 2.5% 4 years ago, it does not matter that the Fed has eased off its peak. The refinancing market is still operating near 6%. Consider the mathematics. A firm servicing $1 billion of debt at 2.5% spends $25 million annually on interest. When that debt resets at today's rates, the annual interest bill rises to $60 million. The company did not become less productive. Its financing reset to a new reality. In the real economy, that shift appears quietly. In a sudden corporate hiring freeze, a postponed logistics project, or a mid-sized technology firm choosing not to renew contracts with its vendors just to preserve cash flow. Corporate balance sheets are entering a multi-year squeeze. Commercial real estate is providing the clearest view of this lag effect in action. Unlike standard residential mortgages, commercial properties rely heavily on short-term, interest-only loans that must be refinanced every 5 to 7 years. Millions of these loans were structured at the absolute bottom of the interest rate cycle. At the same time, remote work structurally altered office demand. In major metropolitan areas, commercial properties are clearing the market at steep discounts, frequently 30 to 50% below their pre-2020 valuations. Owners are forced to refinance depreciated assets using debt that costs twice as much. In financial districts like San Francisco, Chicago, and New York, the consequences are visible immediately. In half-empty office towers waiting for tenants that may never return, and in the quiet closure of the restaurants and retailers that depended on daily commuter foot traffic. This is primarily a banking risk. Regional lenders hold significant exposure to these properties. For now, many banks are quietly extending troubled loans, allowing borrowers to postpone payments rather than force immediate losses onto bank balance sheets. But each maturity eventually forces a repricing. The asset class has not finished adjusting. The public sector now faces the same structural friction. For more than a decade, governments financed large deficits using exceptionally cheap capital. Today, that older, low-yield debt is rolling over into a world of higher borrowing costs. In the United States, annual net interest payments have surpassed $1 trillion, making debt service one of the largest items in the federal budget. Every week, the Treasury rolls over billions in existing debt, permanently replacing yesterday's low-yield obligations with more expensive bonds. This capital does not build infrastructure. It does not improve productivity. It simply services the past. At the local level, the strain becomes tangible. A municipality delays critical repairs to its water systems because financing costs suddenly doubled. A transit authority postpones expansion projects because the cost of borrowing no longer fits the budget. Yet, higher rates do not guarantee economic collapse. They are also redistributing capital. Strong firms with pricing power and large cash reserves can absorb the pressure. Highly leveraged firms cannot. Nominal growth has temporarily softened the adjustment. Revenues rose. Asset prices held up. At the same time, large technology companies remain heavily insulated by historic cash holdings. The result is a widening divergence. Fragile sectors weaken. Well-capitalized firms consolidate. The economy is not collapsing. It is reorganizing. This helps explain why equity markets have largely ignored the threat. For 15 years, investors operated under a regime where economic weakness usually triggered lower interest rates and cheaper capital. But structural forces, including persistent deficits, supply chain fragmentation, and inflationary pressure, suggest the era of free money is over. The Federal Reserve's recent policy adjustments are a normalization, not a rescue. This changes the valuation framework underpinning nearly every major asset class. When the risk-free rate stays structurally higher, investors demand greater compensation for risk. That compresses equity multiples, reduces the present value of future cash flows, and breaks business models built on cheap leverage. The effects are already visible in late-stage startups struggling to secure a runway, in painful down rounds, and in private equity firms unable to exit portfolio companies because the leverage assumptions no longer work for the next buyer. This cycle is unlikely to fail all at once. The pressure accumulates gradually. The interest rate shock did not end when central banks changed direction. The tightening cycle is no longer about interest rates. It is about refinancing, and that process has years left to run.